Welcome back, everyone. We have an exciting episode ahead of us. We've had a busy earnings season, and every single company in my portfolio, the Story Fund, has officially reported their earnings. The results are in. We get to see the outcome, we get to see whether they've gone up or down, and we get to see the fundamental developments. In this video, we're going to be going over every single holding and seeing specifically what happened over the past couple of weeks. This is going to be an overall summary and review of what happened this most recent earnings season and what these companies are expecting over the course of the next 3 months. What are they forecasting in the future, and how do I see my investments in these companies? So I think this is going to be a very informative video. I think it'll be interesting. We have a lot of data to go over. Before we jump into all of that, I first want to take a trip down memory lane. I want to take a look at why I started this portfolio, the Story Fund, originally. I started this portfolio in July of 2020 with the express goal of beating the market. That was the goal. Now, the market, as I define it, is the S&P 500, and that's what most people consider the market. So if you can beat the S&P 500 over an extended period of time, that's beating the market. And beating the S&P 500 over an extended period of time is incredibly difficult to do. We've seen all the data and all the studies of how poorly individual investors do. And I wanted to give a transparent look at my attempt, my go at it, my college try at trying to beat this very difficult to beat index. And I've given myself until the end of 2025. That would be over 5 full years of battling it out against the S&P 500. And we can see how things turn out at the end of 2025. And I've been tracking the progress of this competition of my portfolio against the S&P 500 with this chart on an ongoing basis since the very beginning. This spreadsheet was created by a friend of mine that's a CPA. He's an accountant, and he created a spreadsheet that made it so that every single time I put money into my portfolio, it was as if I bought the S&P 500 at the same time and at the same price it was trading at. That way we can see transparently an alternate reality as if I had invested in SPY. It shows the exact results going on the entire time as if I invested in the S&P 500 instead of my portfolio. The S&P 500 is in red, the Story Fund is in blue. So at the start of this competition, the first year and a half, we were neck and neck, and then my portfolio started to do a lot worse in 2022. I made some blunders, I had some companies do poorly, but I doubled down on my biggest holdings, the companies that I had the highest level of conviction on, the ones that I felt incredibly strong they'd recover, primarily Amazon and Netflix, and both of those companies have recovered sharply. Companies like Netflix, for example, have recovered over 190% since the lows. A huge, massive recovery along with Amazon. The company's up big time from its lows, causing the Story Fund to climb aggressively over the past year and a half. Now, we got to the point where we were break even, neck and neck with the S&P 500 early this year, and with the recent earnings season, with my companies reporting earnings, and a lot of them doing really well, we've officially surpassed the S&P 500. Our returns now are 32.5% against the S&P 500's 26.3%. So right now, so far, so good. We've recaptured the lead. We have a little bit of wiggle room. The companies that we're invested in have a lot of momentum. They're heading in the right direction. And I think we can outperform the S&P 500, but we have to do so over the next 2 years. So how these companies develop over the next couple of years will be the determining factor. But I believe I have a very strong hand of companies to play with here. Now let's go ahead and dive into the past couple of weeks and see what's happened with these companies and why I feel so strongly about them over the next couple of years. We'll start off with my largest holding, which is Amazon. This one makes up over 35% of the portfolio. So it's a massive position, currently worth $73,000, around $15,000 in the green. So we're in the green, 15 grand, but that's not a huge margin. We need to get in the green further with this one, and I think we will. If we look at Amazon's latest numbers, we have them here in Qualtrim. This website's included as part of the Patreon. But let's go ahead and just take a look at some of the basic numbers. We have the revenue here. The revenue grew at a rate of around 12% year over year. So to rephrase that, Amazon's a company that does over $500 billion with a T in revenue per year, and they're growing at almost 12% per year. This shows that even companies that are very large can still grow very big if they have the correct growth drivers. Now, if we look at some other numbers, I think the most important one by far with Amazon is the free cash flow of the company. Free cash flow is a number where you take the operating cash flow, the cash flow from operations, and you subtract out the CapEx. You arrive at this number here, which is the free cash flow. When we look at this over a longer timeline, Amazon looks like a company that was never truly profitable, and those profits were always suppressed because they were always reinvesting. At some point, Amazon was eventually going to get to such substantial scale that they could no longer be able to reinvest all of their money. They'd simply become way too profitable given all of their reinvestment opportunities. And from 2015 to 2020, it looked like this story was playing out. Amazon was getting to scale, we were seeing operating leverage, we didn't see as many reinvestment opportunities. But then an opportunity came. In 2020, we had the COVID pandemic. A lot of retail was shut down by the government, but online ordering was still considered a safe way to get products. Amazon immediately saw an influx in demand, and they had to make a decision. Their decision was to reinvest and double their fulfillment network. This was a massive undertaking, taking tens of billions of dollars in capex. They had to buy new warehouses, new trucks, new planes. They had to buy robots for their warehouses, all the shelving. They need to buy new equipment for all their new employees, all the boots and jackets they wear and everything associated with it. Every bit of piece of devices and controls and robotics and all of that type of stuff is a massive expense. But it's not an ongoing expense. A lot of it, in many cases, is a one-time expense. Now, my thesis during these 2 years, 2021 and 2022, with massive negative free cash flow and all of this investing, was of course that it would yield a good return, that they would get an ROI, a return that's higher than the cost of the investment. So they're getting a positive, beneficial return for the investor. And of course, the return would take a couple years to get. So they do the investments here in 2021 and 2022, and the thought is that you get the returns on it in 2024 and 2025. That's when you start to see the fruits of all of these investments. So right now we're in this period of flux in 2021 and 2022, and then we have 2023. This last year, shown right here, where finally we're starting to see a semblance of the ROI, the return on investment. $32 billion in free cash flow. Now in isolation, $32 billion of free cash flow in a single year for a company like Amazon is not enough. That's not impressive given the size of this company. It needs to generate more free cash flow. But if we look at this with context, this isn't just $32 billion. This is $32 billion after being minus $17 billion the year before. So if you do the math, this is a positive $50 billion swing in a single year. $50 billion in positive free cash flow change from 2022 to 2023. Now, if you don't think that's impressive, then there's nothing in this market that will impress you. This is one of the most rapid, aggressive swings in operating leverage and free cash flow year to year of any company. Now, if we look at this on a going forward basis, this year, 2024, I believe that Amazon will over double their free cash flow again, going from the $32 billion to $70 billion. That's my guess for this year's free cash flow. It'll go from 30 billion all the way up to 70 billion, and that will more than justify the current valuation of the company. Now, of course, I don't know for sure if they will. This is very difficult to gauge, but there's a couple metrics that make me believe this is the likely outcome. The first thing that we can look at going well for Amazon is that the company's showing time and time again that they have massive operating leverage. They're still growing faster than people really expect, even given their tremendous size. And this operating leverage has the effect of tricking analysts. It's incredibly difficult to price into the stock, but they're doing this time and time again. Amazon has forecasted for next quarter growth of 8 to 13%. If a company like Amazon can grow double digits at Amazon's size while keeping their expenses relatively flat, that's where the operating leverage, the margins, and the free cash flow margin kick in. And here we have them predicting growth. Amazon is forecasting growth of 8 to 13% in the first quarter of 2024. Now, 8 to 13% is a big range, but typically Amazon comes in at the higher end of this range. That's visualized right here. Here's going back all the way to 2001. Now, of course, the two gray lines are the range that Amazon forecasts quarter by quarter. The lower gray line is the lower range. The higher gray line is the higher range. And then you have the red line. That's the actual results. That's the actual revenue. And you'll notice quite consistently that Amazon has a history of coming in above or at the high end of the range. So the data illustrates that Amazon's more likely to grow towards the higher end, the 13%, than they are the 8%. I believe they'll grow once again above 10%. Closer to 10 to 12%. And meanwhile, their capex will not grow in line with their expense. They're not doing the same investments that they were in 2021 and 2022. The capex is steadily going down, In fact, it's going down very fast. When revenue grows double digits and expenses go down, that is the margin there. That's the operating leverage expanding rapidly. And that's very difficult for analysts to gauge accurately. Amazon is a vast and complex business, but there's three parts of the business that are incredibly good. These are the core intrinsic value drivers of the company. And proportionate to the overall almost $600 billion in revenue, this makes up the majority of the revenue, over 50%. This is why they continue to grow at rates above 10%. First of all, we have the third-party seller services. So Amazon both competes directly with sellers, just like any other retail location. Walmart has the Great Value brand. Costco has the Kirkland Signature. Amazon has the Amazon's Basic and other white label brands. But that is not the profitable part of Amazon. They do that mostly to give you a full selection. The profitable part is having sellers sell on their website. Amazon loves their sellers because it requires less cost up front and they charge service fees, higher margin than their first-party sales. The seller services, which make up a huge portion of the online retail, now is growing at 19% per year, compared to the first-party sales growing at 8%. So third-party sellers are outgrowing Amazon on their own website, which is a good thing for Amazon. And Amazon's taking over more of the services. They offer a very full slate of things you can do. So third-party sellers really, they don't have to do much. They can just put their stuff in storage and have Amazon take care of everything. All the billing, the customer service, the shipping, the fulfillment, every part of it's taken over by Amazon, and they do charge for that service. In some cases, it can be a lot, but that's if Amazon does everything for you. Now, the advertising services is maybe the best part of this company now. There's a chance that this is becoming more valuable than AWS, which was not even thought possible a couple years ago. But advertising now makes up $10 billion per quarter, over $40 billion per year. It's trending now towards about $44 billion a year. So this is a massive part of the company. $44 billion is a lot of money, but the margins, which they haven't released, the margins must be incredibly high. I think the margins on their advertising are north of 70% because they have incredibly targeted ads by promoting different listings above others. That's where you search in a box, you click on the ad. That is incredibly high margin. It costs almost nothing for Amazon to do that. But the ads on Amazon Prime Video is going to be another high margin addition to the company. Now, AWS, Amazon's web services, recently did $24 billion of revenue in a quarter. It's going to do over $100 billion in 2024. And it's reaccelerated growth over the prior consecutive 2 quarters. So it went from 12% to 13%. So when I look at Amazon right now, I see a company that's in an incredibly strong position, growing its top line revenue above 10%, growing the intrinsic value drivers, the third-party seller services, the advertising business, AWS, all above 10%, and doing so while the biggest expense, the CapEx, is going down. I believe the company will earn that $70 billion. If we look at the valuation today, that would mean based on the current market cap, that the company trades at a 4.1% free cash flow yield on 2024. 4% free cash flow yield for a company like Amazon, with the strengths it has, the moat it has, the optionality, not to mention stories that haven't even played out yet. Like Amazon really hasn't been recognized as an AI company that's been taken over by Google and Microsoft, but I think Amazon has every bit to benefit as much as those other companies. So there's other parts of the story that aren't even in play, but even if those don't work out, even if it's just the story of margin expansion, I think this company's priced at a valuation that's still good. It leaves a lot of upside in it, and it's one of the stronger companies in the market. So I see this as a bet that I think is very strong, and I think it's likely to outperform the S&P 500 over the next 2 years. Next up, we have Netflix, my second largest holding in this portfolio. It makes up a 28% position. So this is a massive weighting into this company because I feel very strongly about it. Netflix is a $58,000 position with $12,600 in the green. Netflix is a company that I have a difficult time getting any investor or retail investor or anyone else on board with this investment. Most people don't like the company. They might have the product and be signed up for a plan, but they don't view it as a great investment. And I believe that part of that is because we've been told over and over again that streaming is not a great industry. It's full of people that are selfish and they like to hang out with celebrities. They pay themselves a lot. They take advantage of all the profits and they basically keep the profits to themselves. There's other notable people like Aswath Damodaran, the dean of valuation, that has said quite openly that Netflix is a broken business model. For that reason, it's off his list. He doesn't like the company enough to really look at it. So a lot of people, I believe, see these type of comments. They see a lot of content regarding Netflix. And historically, the company has also been unprofitable, which I think has caused a lot of people to discount the potential in this company. Now, I don't agree with Aswath Damodaran. I don't believe that Netflix has a broken business model where they're just on a hamster wheel, spending money on content and burning cash. In fact, I disagree so strongly with this that I believe Netflix has one of the better business models in the market from the companies that I've observed. If we look at Netflix and consider what they really do, they charge subscriptions so that you can watch television. And if you like watching television and drama and entertainment and ongoing long format series, you're going to have a Netflix subscription. Eventually you will, because they control a huge percentage of all of drama that exists on television. They either license it or they create it themselves. So they have a royalty on entertainment, on drama for the world. They grow their revenue consistently, which is subscription-based revenue, almost 100% of it. Not like 70 or 80%. This is all subscription-based. So you have this nice reoccurring revenue every single month from Netflix. They also have proven time and time again that they have pricing power. You can look through the prices of Netflix going throughout history, and they continually price it higher and higher. And although people grumble and they don't like the higher prices, they end up paying because they want to be entertained. And this company offers a huge amount of entertainment. Now, if we look at the history of Netflix and the profitability, here's where a lot of people have criticisms. Prior to the last couple of years, in fact, just this last year, Netflix looked like a unprofitable money-burning company because at the time they realistically were. From 2014 to 2019, the company reinvested not into CapEx technically like Amazon, but instead they invested into content. They were building out a content library, distribution of different studios all across the globe to gain more subscribers. So subscribers were going up, content costs were causing their free cash flow to go down. And a lot of people thought this was an unsustainable business model. But Netflix knew that if they could get the subscribers, if they could get the revenue, eventually they can stabilize their content costs while continually growing revenue. Very similar to what Amazon's doing. And we've seen that happen over the past 2 years. We look at Netflix in 2022. We got the first glimpse of free cash flow, positive $1.6 billion. So we have real cash the company's generating. Then only 1 year later, Netflix generates $6.93 billion. Now, a portion of this was because of the writers and actors strike, which caused them to spend a little bit less on their content costs. So content costs went down a bit, causing their free cash flow to go up. But regardless, this was still one of these massive swings in operating leverage from a company that has reached critical scale. Now they're at a point where they're a cash generation machine, generating $7 billion in 2023. And then we can also look at the forecast going into next year. So this is what management expects going into 2024. This year, management expects double-digit revenue growth. So strong top-line growth from Netflix. The company a couple of years ago was talked about like it wasn't growing anymore. They're expecting double-digit revenue growth, which I think is very positive. Now, they expect that on a constant currency basis. So that's if you rule out currency fluctuations. And they also expect it to be driven by membership growth and constant currency average revenue per member growth due to price increases. So more members, more subscribers, and a little bit higher prices per subscribers. Operating margin guidance for this year was raised from 22 to 23%, all the way up to 24%, compared to 20.6% last year. So that is a 340 basis point margin expansion year over year. So we have top-line revenue growing above 10% and margins going up over 3% per year. Sounds similar? Very similar story to Amazon. Top-line revenue growth and margins expanding. First quarter guidance calls for 13% revenue growth and 16% on a constant currency basis. Free cash flow is expected to be another $6 billion. Management said that explicitly. They're expecting around $6 billion. Now, that's down a bit over the previous year. We just looked at it. It was close to $7 billion. But remember, there was the writer strike and actor strike that slowed down content spend. So going into 2024, they're expecting it to go down $1 billion. But here's the key thing about the free cash flow going down. Organically, the cash flow is still growing because it's down a little as cash content spend is expected to increase by $3 to $4 billion. So even as Netflix spends $3 to $4 billion more this year than they did last year, free cash flow is only going to go down $1 billion. And Netflix typically comes in somewhere light on its cash content spend guidance, meaning that if that's true again, the free cash flow they generate this year will be above $6 billion. I'm expecting it to be again closer to $7 billion, what it was last year. And there's a very high probability that free cash flow will gain again in 2025 as they gain more revenue with their fixed costs. So here you have a company that is now producing between $6 to $7 billion in that area code of free cash flow, which is highly efficient. They're not diluting it. There's barely any stock-based comps, so all of that can be returned back to the shareholder. What are they doing with that? They're not paying a dividend. They're just sending it back to the shareholder through share buybacks. Now, this is more difficult to see. If we go to the quarterly here, we can look at the share buybacks already happening. If we look over the past 2 years, the shares went from 452 million down to 444 million. So they're buying back tens of millions of shares, around $6 billion last year. And I think they'll buy back another $6 to $7 billion this year. Now, of course, Netflix's valuation has ticked up to a 32 forward PE ratio and a 3% free cash flow yield. So it's now at a more full valuation, but I believe with the buybacks, the efficiency of growth, and the operating leverage in this company, I still believe it presents a better bet than the S&P 500 as a whole. So over the next 2 years, I expect Netflix to outperform. Of course, there's a chance that doesn't happen. So there's risk with all of these companies, but I believe the odds are in my favor. Now, moving on, my third largest holding is Google. It represents a 17% position, and it's currently at $35,000 in value with $9,000 in gains. So this one has been a profitable holding so far, and I believe that the story with Google isn't over. If we look at the most recent quarter, we can take a look at some of the financials here. I thought Google did fine. Now, the market didn't like their earnings report. It sold off very sharply right after the earnings report. But when I look at this, I didn't think it was too bad. It went down like 8%, and you can already see the market starting to trade it back up. It's already regained over half of its losses. So it's still up around 7-8% year to date. Not too bad. The company grew revenue over 14%, or around 14% year over year. So strong top line revenue growth. We have profits going much higher. We can see that there is pull forward in 2020. Lots of people stuck at home, using Google services, watching YouTube. The following year, some of that pull forward demand fell off, and then Google has resumed its growth. The earnings per share are now back to all-time highs. If we look at the free cash flow on the quarter, it looks a little low. It's one of the lowest free cash flow quarters they've recently had. They had some one-time expenses. But if we look at this on a full year basis, it actually looks really good. I look at the free cash flow and I see strong free cash flow growth with this company. They've gotten ahead of the 2021 peak to an all-new high of nearly $70 billion in free cash flow. So Google's still generating money on a very consistent basis. Now, they do have some issues with a lot of employees that they hired over a short period of time, causing the stock-based comp to go up and dilute the free cash flows a bit, but they are getting this under control. What I noticed going through the last 4 earnings reports is the amount of employees is staying either stagnant or it's even going down a bit. They're getting the costs under control for the company while growing free cash flow. Now, Google, of course, does a lot of buybacks. When you remove shares outstanding, it makes the free cash flow on a per share basis grow even faster. The free cash flow per share over the past 5 years has grown at 27% per year. That's one of the fastest of any companies that I own. Not quite as fast as if you add in like Netflix, but that's really unfair because Google was earning a lot of free cash flow 5 years ago where companies like Netflix were not. So 27% free cash flow per share growth off of a base of already really high free cash flows is tremendous. And Google should be noted for this type of accomplishment. It is incredibly fast growth. Now, looking at the valuation of Google, this is also very compelling because of the fears around Google's moat. The fears around whether or not search is a commodity and being taken over by different companies, Google is traded down to a very undemanding valuation. It trades at a 22 forward PE ratio. That's very similar to the S&P 500. So it's trading right in line in terms of next year's earnings with the S&P 500. It's also trading in line with the S&P 500 in terms of free cash flow yield. The S&P 500 is right around 3.5%. So Google's trading as though it's the average company in the S&P 500. But Google has a much superior business model than most companies in the S&P 500. It has a faster growth rate than most companies in the S&P 500. It has a much better balance sheet than the average company in the S&P 500. So when I look at Google, I believe there's a high probability that it will outperform the S&P 500 based on what's priced into it and its current growth rates. There is a chance it could be disrupted. Maybe the search engine goes to zero. There's always a chance of that. I think it's unlikely. So I'm making a bet with Google. Next up, we have Microsoft. This makes up a 10% position in the portfolio. Microsoft was a company that I was pounding the table a year ago. When the company was trading around $230 per share, I came out with videos saying it's undervalued. I did everything I could to express my belief the company is being too heavily discounted. And times have changed. Over the past year, Microsoft has now traded back up from $220 to $420 per share. The share price has literally doubled while paying dividends. The company's valuation has also raced up to a much, much higher valuation. When I look at Microsoft now, I don't think it's the best deal. I don't think it's the best deal in the market. It's an amazing company, and I've routinely said that this is the poster child for the perfect fundamentals of a company. It has such consistent, reliable growth. It has all the factors I look for, but the valuation is a stretch at this point. The PE ratio is nearing a 40. The free cash flow yield is now below 2% if you include dilution, a little bit above that if you don't, and it pays barely a dividend, around a 0.7%. So it's just at a very high valuation, and I see very little room for more valuation expansion in Microsoft. So the return from this company is if the company maintains its current valuation and grows organically at a high rate. That's a lot more to expect out of the company than a year ago when it was $220. When I look at Microsoft, the latest earnings were like you would expect. They were great. The company's so predictable. It grew its revenue. Azure's growing at a faster pace than people expect. Microsoft has all their social media businesses. They're in AI as well. They have everything going for it. But looking at Microsoft now, it's not at a point where I'm buying the stock. Right now, I'm just holding. I have a little wiggle room when companies get into the overvalued range because they tend to go up more and more and more than you'd expect. They can get more overvalued and overvalued than what your analysis can show. So I have some wiggle room here. I'm holding on to the stock right now, but I'm certainly not buying it at this point. When I look at my portfolio, it's a constant debate of whether or not I want to take gains or whether or not I want to continue to hold Microsoft and let the company just continue with its momentum. Right now, I'm holding it. But at some point, I may take some off the table. I may reduce the stake in the company and add it to ones like Google that I think have a bit more upside. Now, next up, we have S&P Global as the smallest holding in my portfolio, making up a 9% position. I currently have $19,000 of value in this one and currently at $2,500 of gains. But S&P Global has run into a little bit of a bump in the road with the most recent earnings report. It sold off a bit after hours. It was down 8% at one point. So it went from here to here, which wasn't great. Now, it's regained a little bit. It's only down around 5% after earnings, but it's still given up its year-to-date gains. Now, that seems like a big deal in the moment, but when you look over the past year, it's up 20%. It continues to climb, and it's not the biggest deal when you look at these companies over a longer timetable. When I look at the most recent report, I wrote something for Discord members. This is part of the Patreon, but I want to go through my analysis of what happened the most recent quarter and what they're expecting next quarter. The shares falling is credited to a 1 penny miss on earnings per share and soft guidance. So they missed EPS by 1 penny, which is not a big deal, but they also gave softer than expected guidance, a little bit more timid guidance, which I think was the bigger problem for the market. If we break down by segment, the revenue of each part of this company, they beat on 3 segments and missed on 1. The one that they missed on is their smaller segment, which is mobility. And they only missed by $2 million. So overall, they beat their revenue estimates across the board. They missed slightly with mobility, which is not a big deal. If we look at the full year numbers for 2023, this also looked pretty strong. The organic revenue grew by 8%. The operating margins increased by 1%, and earnings per share came in at 13%. So double-digit earnings per share growth, high single-digit revenue growth, and operating margins increasing. It's basically everything you'd like to see with a great company. I thought 2023 was a good year for S&P Global. In terms of their forecast for 2024, this is the more weak forecast that investors were concerned about. They said on the headline that revenue was going to grow between 5.5 to 7.5%, which sounded oddly low. But I looked into that, And that is with the engineering solutions being sold. Organically, they say that the revenue is expected to grow closer to 9%. So organic revenue growth is still very strong, closer to 9% growth. The operating profit margin is going to expand another 1%. Earnings per share is expected to grow between 9 to 11%. Free cash flow is expected to come in at $4.4 billion at plus 7.3% year over year. And they're also saying they're going to buy back $3.75 billion worth of shares, which is currently around 2.6% of the current market cap. If they do those buybacks, that'll make it so the free cash flow per share grows above 7%, closer to 10%. So you have around 10% earnings per share growth, 10% free cash flow per share growth, and that is the timid guidance they're giving. Now, when I look at that, I don't think that was such bad guidance. They're still growing their free cash flow per share at a faster pace than the market. And another thing that could optionally help out S&P Global is if the Fed cuts interest rates. If that happens, which there is a chance of it, S&P Global will have a lot of companies that rush out to raise new debt at a lower price. If companies do that, then S&P Global will make money rating that debt. So there is optionality of them growing their free cash flow a little bit faster than expected. But right now, the company trades at around a 3% free cash flow yield. It's growing free cash flow per share at a healthy pace, and I believe it's a much higher quality than the average in the market. So I'm still very bullish on S&P Global. And overall, this latest earnings season went really well for my companies. The fundamentals are moving along at a very fast pace, and I'm still very excited about the future of each of these investments. So that's my thoughts on this latest earnings report. If you want to see more content like this, just make sure you're subscribed to the channel, and I'll see you in the next one.